Good morning. The tape for February 12, 2026 reveals a clinical divergence within the Magnificent Seven that institutional allocators can no longer ignore. While Alphabet has successfully optimized its AI stack, slashing Gemini serving costs by 78%, Meta Platforms has officially hit the reality wall. Mark Zuckerberg has effectively mothballed the Metaverse narrative to fund a $135 billion sovereign infrastructure pivot, a move that has triggered a 50% projected compression in free cash flow. We are witnessing the end of the unified big tech trade and the beginning of a Darwinian separation between those who monetize tokens and those who merely incinerate capital. The numbers are unprecedented. The collective 2026 capital expenditure guidance for the cohort has reached a staggering $700 billion. To put this in perspective, Amazon leads the spend at $200 billion, predominantly for AWS infrastructure and custom silicon, followed by Alphabet at $180 billion and Microsoft at $144 billion. Meta's midpoint guidance of $125 billion to $135 billion represents an 87% surge over 2025 levels. While NVIDIA remains the immediate beneficiary, capturing nearly 50% of this spend, the NVIDIA tax is driving a massive verticalization effort. Meta is currently deploying its 3-nanometer MTIA-V 3-Iris silicon and has secured 6.6 gigawatts of nuclear power to bypass grid constraints, moving its long-term debt load to $58.74 billion. Our 5-year outlook suggests we are moving past model overhang into the era of agentic infrastructure. The strategic pivot of 2026 is about AI sovereignty. Microsoft is aggressively pursuing AI independence by developing proprietary models to reduce its $13 billion reliance on OpenAI. However, the critical risk for 2026 remains the monetization gap. Unlike Amazon or Google, Meta lacks a B2B cloud business to offload excess compute. If the personal superintelligence agent fails to drive immediate transaction revenue, Meta faces a massive stranded asset risk. Institutional sentiment is shifting. The market is no longer rewarding the build phase. It is demanding a measurable return on invested capital as these firms transition from software companies into energy-intensive industrial utilities. That is the data for the morning session. For daily institutional-grade analysis and real-time alerts on the Mag 7 yield cycle, hit the subscribe button for daily notifications. We'll see you at the opening bell.